Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is October 31st, 2024. Happy Halloween. And for Halloween, we're doing something scary. We're going to give you the catalysts and the confirmation that we have stagflation, but there's also some opportunities. So maybe we get some tricks and some treats in today's move. So starting out with what we saw bonds bounce up today, closing higher while equities sold off, one of the largest sell-offs that we've seen in equities in a very long time, with a gap down and close down on the SPY, which means in the overnight we began that. You can see that clearer in this move down through today's low. Now that's the very large candle, the largest candle we've had, unless we go all the way back here, which was also part of a big pullback. So could we be facing this type of a pullback from 56.78 down to 53.80? We'll call that 300 points. If we're talking about from this high, could we be going back down to the 5600? And I think the answer is yes, and not only yes, but likely going to happen over the next 2 weeks. As we're pushing into these lows, we're doing this with volume. And the sell-off that we're seeing here, we've talked about this in detail, that if we're looking at this move and looking at the reaction, this move, when we talked about it up here, we said there is no volume in this breakout, don't trust it. Well, sure enough, we're falling back down to this support. Now, if we break this support level, we should duplicate that pattern, whether it's going to be a funny looking head and shoulders pattern or a double top type pattern. We're going to break down and likely see this whole pattern repeat. That pattern will be about 200 points, and we'd be looking for probably 50 to 5600 again on this chart. So there's a lot that could happen here in the next couple of days with the sell-off, but part of the drivers or the catalysts that are going into this is stagflation. Now, when we talk about stagflation, we're going to talk about economic data. Economic data today showed that inflation is holding up near where it was before, 0.3%. That's core PCE. And that core PCE is showing us that inflation is not slowing down. If we look back to the GDP that was reported yesterday, we are slowing down. So we went from 3% and we're slowing down to 2.8%. So we are slowing down in growth, in advanced GDP being the number one GDP report we look at. If we're slowing down in growth, but we are not slowing down inflation, this does set us up as a catalyst or confirmation that we are in a stagflation type of scenario. What else would drive us into that stagflation type of scenario? Yields. Now, when I talk about yields, we're talking about the 10-year Treasury yield, and the 10-year Treasury yield has held at this 4.25 to 4.3% rate that we've been at for the last week, and it's the highest level that we've been at for over 3 months. So we're holding at a 3-month high in interest rates. And that 3-month high is erasing a lot of hope, a lot of rate cuts, a lot of ideas and hopes that we're going to have lower costs, lower expenses going into this next quarter. We've unwound it all. And the data would show us that we should not be cutting rates again, that we're seeing inflation hold up. And if we're seeing inflation hold up, that means we're probably not going to cut rates. If we're not going to cut rates, then what would we expect? So we're going to look for another confirmation. If rates are going to remain high in the short term and the long term, this is the 10-year Treasury, and therefore cost investors money, it's going to cost consumers money, and when I say investors, I mean businesses when they're borrowing. If you're borrowers, it's going to cost you more money to borrow now than it did just a few months ago, and we're pushing up, pushing higher. So that means more costs, more expenses, and more expensive even for the U.S. government. And then add to that that would also slow down home builders because people will not be able to finance those homes at these higher rates. So the rates are staying high, so what is the other thing that we'd expect? If rates are going to stay high, then we don't need to hedge inflation as much. So inflation is holding at a high level. Yields are holding at a high level. We're not expecting the rate cuts that we once thought. We were pricing in 8 rate cuts at one point by the end of the year. Now we're pricing in maybe 0 in December, 0 rate cuts, or maybe 2 rate cuts by the end of December. So we've really pulled back on that rate cut, and therefore we would expect and have seen that gold can breathe out. We don't need to hedge out the inflation. Inflation is hedged by gold. But if we think the Fed is going to act, or in this case, not act by cutting rates, we don't need to hedge as much. It doesn't mean gold's going to go down, but it's probably going to go stabilize and represent inflation as it is and not hedging inflation and pushing this higher. So I see this pullback in gold the confirmation that inflation is there, inflation is high, the Fed has to see that it's high, and they're not going to be cutting rates and therefore not going to be accelerating inflation in the near future. But without growth and holding inflation, that is stagflation. With higher inflation and no growth, it's even worse stagflation. So where do we look? Well, I'm looking at a couple things. One, I'm expecting that higher rates to borrow and maintaining higher rates to borrow will hurt the small cap, the technology companies, and the home builders. So the best bets for me right now are to short home builders, short the tech sector, and short the small caps. And if we look at technology sector XLK, we've already seen that we have a gap down, close down. We've traded below the lows and gapped below the lows of all that bullish breakout. The easy target, the short-term target, would be a retest of about 219.80 or we'll just call it 220. So we've got maybe another 1% move lower in the tech stocks. If we are doing this was an 11% move. And if we do an 11% move off the highs, we are going to go back down to this 217. In fact, if we go right here, get a little bit more specific, we are going to fall all the way back and likely find this same low. So not the lowest price, but the lowest close right in here. That's the same 11% move off the high as this was an 11% move through here. So we could pull back 11% and find 207. My concern is, will this time be enough to tip beyond this 11%? Are we going for 20? Looking at the Russell using the IWM as our example, what we're going to see is a pullback to the yearly monkey bar at the 0%, kind of an inflection point, but a close below here should not only test to 11, but probably go back and test the same lows that we were just looking at with the NASDAQ, and looking for about a 208, so an $11 move from the current price, if we can break through this support. If we do this type of a move, this was an 11.5% move through here, and that type of a move we'd be looking, sorry, a 14% move, and we're looking for 32 points off the high. So if we do the same thing here and we go for the 32 points off the high, or 15% move, we're talking about a retest all the way back to July's lows. Kind of significant for IWM. Let's take a look at ITB, home builders. And I think home builders is probably one of the ones that I really would love to be in those trades again short. We talked about it 2 weeks ago. 2 weeks ago I said this is the sell-off, and it should be able to repeat at least what we did before, if not what we saw earlier in the year when we dropped all this distance. This is going faster than what I thought. We talked about shorting back here. Already a fantastic directional move, but the move could be even more dramatic. If we look back for the last year, it could be a downtrend that establishes and trades for weeks and months. I'm not just talking about this pullback, which was more dramatic when we saw about a 13% pullback. We've already done that right through here. We've already dropped that distance. But what if we do something more like this? And we're talking about a 20% decline. And if we get through 20%, that takes us all the way back through July as well. And now we're talking about a 30% drop to retest 100. ITB looks pretty promising, but ITB is already adjusting for DR Horton gap down, close up. The one I like the best for here is Toll Brothers. Toll Brothers hasn't reacted as much right through here as DR Horton and the broad sector ETFs, but Toll Brothers also has one of the worst as far as the quick ratios. So if rates stay high, they can't make it a year. They can't even make it 5 months without selling inventory. So if rates stay high and they're not selling inventory, they will go out of cash. They'll be done. Their quick ratio tells us that they could make it a while longer, but their current ratio says they can make it longer, but their quick ratio says they have to sell inventory to do it. So they don't have the cash flow they need, and this is the one I think is the better opportunity for the way down. We could easily test those July lows, which means we're talking about a 20-point move, and then we could go all the way back like I just did on ITB, and we could go all the way back down to the lows in July and through the lows of the year. And the move from even where we're sitting, going back to July, we're talking about a 15% move. The ones early July, we're talking about a 35% move, and then erasing the year, which I think is possible, we're talking about a 50% correction in Toll Brothers. I know a lot of people don't like taking bearish trades, so let me show you a couple of ideas that would fit into the bullish view, and that would be still to the defensive sectors. We could certainly go back into utilities. Utilities have done great, but let's look at consumer staples. Consumer staples gave us a lovely little bounce here, and after that bounce, we've moved up to the high, and this is a widening candle. So it's a good bounce. It's a tradable bounce in my book. If you create a widening pattern at a key support level, we can trade either at the close of the day or a trade above the high of the widening candle. XLP could be a great trade just to trade it back up to 82.40, but that's not that big of a move. It's about 2.5%. So instead, I'm looking into the things that we need within the things that we need. Consumer staples, we could take it another step further and say, we need to eat. We need to eat to stay alive. So I'm going to look at Tyson Foods, and I'm going to look at General Mills. Tyson Foods has stabilized for the last month, right around 57.58. It's not the best bounce, but it's a good bounce. It's a confirming bounce. And if we create a double bottom, this pattern could go from 58 to 60, 61. So you'd say it moved to 64, maybe 65. And the risk to do that really is just $1. Would you risk $1 to make 5? Would you risk $1 to make 7? So if Tyson can maintain this support here, and if we can maybe even sell puts or put verticals or simply buy the stock and sell calls against it, this could give us an opportunity to trade all the way back up to 66. I believe the market is already priced in anything to do with the avian flu. We're already past that. We've already seen the drop, and here we are stabilizing after we found kind of a base. A news-based move followed by a support. This looks as good as you can get for a low cost, low risk opportunity for a big reversal. General Mills, very aggressive pullback, about half the range from the run up from 62 to 75. I like the bounce here because today is the confirmation as well. We could have called that the bounce, and today is the confirmation. A move for General Mills from 68 to 71 or from 71 up to 75 could give you about a $7 to $8 move. And that means we're looking at 10 to 15% to retest those highs. If we break the downtrend, I think it's even stronger. The consumer staples sector can do well even during a stagflation situation. We still will have a tendency to spend the money on the higher cost items that we need to survive and those stocks that support that. And so anything in the consumer staples, but certainly General Mills, Tyson, and then anything in the food sector will likely be an opportunity to have low risk trades. Even if they don't go up, they're going to be probably a safer place to be. Tomorrow morning, we'll talk a little bit about the earnings. We'll talk about Apple, and we'll talk about Amazon. We'll talk about Intel. We will continue to discuss this idea of stagflation and how we can prepare for it, because I don't think there's any signs that this is going away soon. But join Brandon and I in the morning, and we'll talk to you about that then. Have a great night.